Well, hello everybody. It's your boy Chicago Sean. Welcome. It's Sunday night, February 21st, 2021. Hope everybody's doing well. As you can see, the sun is shining outside my window. I got a great hike in yesterday. Feeling good, feeling ready to tackle the markets this week. And here's what I want to talk about in the video today. First off, I'm going to have a discussion about something that the YOLO options traders might find interesting. It's a little thought experiment I thought I'd throw at you. More questions than answers, but I think it'd be a good exercise to go and ask these questions and think about ways that you might be able to trade options better if you're one of these people who just likes to buy long calls and buy long puts. Secondly, I'm going to talk about how to repair a long call trade that's going sideways or going against you. A position that you still want to stay in, but you want to minimize your risk a little bit. So I'm going to tackle that. And then lastly, I got a couple questions that came in from people about certain stocks that they're thinking about putting trades on, and they wanted my opinion on ways to play it. So we'll get into that. Now, first off, I'm going to talk right here into the camera. I'm not going to share my screen. I just want to have me and you face to face talking about an exercise for all you YOLO options traders. Now, people have heard me riff about this many times before. Any trade you put on, doesn't matter your time frame, doesn't matter if you're a swing trader, a day trader, a long-term investor, any trade you put on, there's essentially four possible outcomes for that trade. You can make a little bit of money, you can lose a little bit of money. Those two are obvious. Or you can make big money, or you can lose big money. Those four things are really the only outcomes possible for any trade in any time frame. Now, as traders, if those are our four possible outcomes, if all we can do is eliminate the big loser from those four scenarios, then mathematically we've set ourselves up for success. But we have to be willing, and I know this sounds crazy, but you have to be willing to ride a winner and have a big win. Because if you eliminate the big losers from your trading arsenal, and then you have a whole bunch of small winners and small losers, which you ultimately will, and they will generally offset each other, you'll be net flat. It's the handful of big winners that will make or break your day, your week, your month, or your year. You need those big winners, and it's only going to be a handful. You could do 100 trades, and it might only be 5 that work out to be big winners. But the math works when you have the big winners and you don't have any big losers. Now, this becomes really interesting when you start thinking about long options. Just a simple purchasing of a long call or a simple purchasing of a long put if you're bearish. The nice thing about that is your risk is defined. You can't lose more than the premium you paid for that option. So as long as you're sizing your positions properly and not buying more contracts than you could reasonably afford in your portfolio, as long as you're not risking, let's say, more than 2% of your capital in any one trade, then you are putting the math in your favor because your risk is defined. You're not ever going to take that big loss if you haven't risked a whole lot of money putting that trade on. And your risk is defined. The most you can lose is that premium you paid. Now, you're going to probably have a whole bunch of small losers and small winners, right? But if you're willing to hold that option, whether it's a long call or a long put, all the way to expiration, that's when you put yourself in a position to have a 5x winner, a 10x winner, a 20x winner, right? And again, it only takes a handful of those over a large series of trades to make the math work for you. Now, one thing I've been thinking about is when I'm bullish or bearish, just buying at the money calls or puts, maybe slightly in the money, right? And then giving myself a binary decision. Every morning when the market opens, I look at all of my positions on my positions tab, all my long calls, all my long puts, and all I have to do is make one decision. And that decision is that option in the money? If it's not in the money, that means the price action of the underlying is not moving in my direction. And you know what? I'm going to be aggressive. I'm going to cut it out, close the trade. That's it. Simple decision. If it's out of the money, it's gone. If the option is in the money, do nothing. Just hold it. Continue holding it. Hold it as long as we can, right? The goal is to hold it all the way to expiration. Now, I don't care if you're doing this exercise by buying an option that's a month to expiration or 3 months to expiration or 9 months to expiration. The mechanics are the same. If it's in the money, hold it. If it's out of the money, close it. You can always get back in. If the stock moves back up to that strike price and goes through that strike price, you could always buy it again. Now, I wouldn't I caution you, I wouldn't do this on weekly options. I don't think. I just think that's too much. You're really running up against the gun for anything to happen for you. It probably could happen, but I'm not doing it on weekly options. I'm looking at least a month expiration, maybe 2 months, maybe 3 months. Again, that's up to you on your time frame. But guys, if you find stocks that you like, I don't care if you're bullish or you're bearish. If you got a technical reason for getting into that trade, or maybe it's a fundamental reason, or maybe your uncle gave you an idea. I don't care where you got your ideas from. But if you got an idea and you play it with long calls or long puts, and you use this binary decision making every day where you're holding it if it's in the money, closing it if it's out of the money, and otherwise, if you're holding it all the way to expiration and closing on expiration day, I promise you, over time, if you take enough of these trades, the math is going to work out for you, because you're going to have a bunch of small winners, a bunch of small losers, and out of 100 trades, maybe 5 or 10 of them will be big winners, and the math will work in your favor. I'm confident that it will. But I'm not telling you how to trade. I mean, this is just a thought experiment. I know there's a lot of YOLO options traders out there who just like to buy calls and puts. Give that some thought. Think about it. Leave some comments for me in the comments section. I'd love to hear what you have to think about it. Let's talk about some more. Let's bounce ideas off each other. That's why I'm doing these videos. That's why I'm having these discussions. Okay, so now let's move over to my computer screen here. Let me change the view here. Sharing my screen. I know last video I made, my platform it was very small. It looked like it was probably a little bit hard to read. So hopefully this looks a little bit better. You can see the data on the platform a little bit better. But I had a question for somebody who came in about this ticker ARKG. And this lesson will apply to any position, but since this is the stock that this person was asking about, we'll talk about it. This person is currently holding a bullish call, owns the 119 calls in April, and as you can see, they're out of the money. The stock's trading around 107. He's got about 50 days expiration. He needs it to get to 119 for the options to be in the money, and as you can see, we are currently out of the money. Let me pull up the options chain. You can see the April, they got some weird prices. There must have been a stock split here at some point, but he's got the 119.21 strike price. And he's worried. He said, look, I paid $7 for these calls and I'm down, over 50% or nearly 50%. What do I do? What do I do? Well, the first answer that I would always give in a situation like this is like, look, if you're holding a trade and you're losing money and it's making you nervous, close the trade. Just close it. You can always get back in. You can always put a new trade on and a new options expiration at a new strike price. Treat it as a brand new trade. But whenever in doubt, get out, right? That's something I always say. But it sounded like this person really wanted to hold on to these calls in April, just wanted some ideas on how to mitigate risk, how to lessen the impact. And a simple way to do this, it's not a perfect solution, okay, but at least will buy you some time and lower your risk, is if you're holding these long April calls, the 119, let's go up to March, closer to expiration. These only have 26 days of expiration. And let's go to the same strike. And here we don't have that decimal, but it's pretty close. It's 119 versus a 119.21. But you can go to the 119 calls in March that are currently bid at $1.60, and you could sell an equal amount of calls. I mean, he didn't say how many calls he was holding. I don't know if he's holding one long call or 20 long calls, but you could sell an equal amount of calls in the March same strike, basically creating a calendar spread. And now what'll happen is if ARKG continues going down, your position's still going to lose money, but because you're short these March calls, these calls are going to go to zero a lot faster than these calls are going to go to zero. So it's going to slow down the decline of the total position value. And if you sell these calls for, say, $1.60 and the 119 never goes in the money while you're holding a position, these calls will expire worthless, and now you've just lowered your risk by $1.60. Okay, so right now the position you're holding are these April calls. They're bid 350. That's the most you could lose right now, per contract. If you sell these March ones for $1.60, you essentially cut this risk in half, a little bit less than half. But hey, it buys you more time if you're really dead set on holding those April options. But I think really the best course of action here is just to close the trade down and try something new. Sit back and wait for the stock to set up for another, start moving higher again, or select a different strike and a different expiration series. All right, two more questions that came in. Stocks that people wanted me to look at. First one I'll pull up is a stock I'm not very familiar with. Stock XL. This is XL Fleet Corp. Pull up the chart here. You can see the chart had a massive spike a couple months ago. It has since given it all back, consolidated in the, 18 to 23 range for a while, and then it just broke lower at the end of this week. My thoughts on that trade are, the person who asked the question, he was kind of thinking both things. Like, he's like, hey, this thing has potential to trade down to 14, or it could, break out higher again. Well, in a situation like this, you've got two options, right? You got to decide, are you bullish or are you bearish? With the volatility is pretty high. I see the IVR rank up here at 61. That's, in the upper 60th percent of the volatility over last year. I don't want to be a buyer of calls or puts, straight calls or puts, when volatility is that high. It's too expensive. So if I'm bullish in this stock right now, if I think this is about as low as it's going to go, has the potential to go higher, I'm not going to buy calls. I think I'll be paying too much to participate. Instead, I'll be looking to sell some puts here. Maybe sell the 15 strike. Let's see what's available here. If I go into April options, that's probably what the month I would look at. Look, you can sell the 15 puts for about $2. Let's go back to that chart again. Look, you can sell these 15 strike puts for $2, which means your break even would be about 13. That gives you a lot of room to be wrong, and they'll still give you some potential to participate on the upside. But even if the stock goes down, as long as it doesn't go down below, say, 15, you're still going to keep $2. So I like that trade if you're bullish. I wouldn't get aggressively bullish in this stock right now. I don't like this pattern. So for me, if it was my money, I'd sell puts if I really wanted to put on a bullish trade in XL. Now, if I were bearish in XL, what I would probably look at, because again, volatility is high, I don't want to be a straight buyer of puts, and I don't want to buy a calendar spread either because the volatility is high. I think what I would do is I would buy a bull put spread, maybe buy the 18, the in the money 18 puts, and spread it off against selling like a 13 put below, because these puts are going to have some nice premium because volatility is so high. In fact, let's bring up the options chain again. I would again look in April. That would be my sweet spot. Oh, we don't have an 18 strike, unfortunately. So your choice is buying the at the money put or the slight, further in the money put. I guess I'd buy the 20. I think I would buy the 20 put and maybe sell it against the 12 and a half. I'm sorry, I did that wrong. I want to buy that put. Maybe sell the 12 and a half. Maybe sell the 15. I don't know. It's a toss-up. Maybe do the 12 and a half. So you would pay about, or it cost about $4.25 to put that trade on. You're getting some juicy premium to sell at the 12 and a half strike, which is a pretty big move down from here. Let's bring up that chart again. 12 and a half. The stock would have to fall all the way down here before those short puts went in the money. So I like selling those. I feel like that's free money. I hate to say free money, but it feels like it's free money. It'll help reduce the cost of the trade. And I'll have a bearish trade on all the way down to 12.50. So that's how I would play XL. If I'm bearish, I'd buy the put spread. I'd buy probably the 20 strike and sell the 12 and a half in April. And if I'm bullish, instead, I would sell these puts, the 15 puts. That feels like the right strike for me. They have about a 28 delta. You can see right here. Which, sidebar, I had another question came in. Somebody was asking, how do I find the deltas of options? Look, I don't do any math to find the deltas. My trading platform shows them to me. You can see right here, I got the delta column. These are all the deltas for each strike. And I had to find this, right? I have a lot of different options here to choose of what to show. I just chose delta. Every trading platform is going to be different. Your trading platform, if it's a reputable options broker, it should be giving you the opportunity to see delta. If you don't see delta, if you don't have any option to see delta of your options, tough love, man. You got to find yourself a new broker. No options, no serious options traders trading without delta information. It's kind of a basic need. Okay, the last question that came in, somebody was asking me about Facebook, what I thought about Facebook. Let's bring up the chart here. Let's see, where is it? There we go. He was talking about Facebook was stuck in a range, and I agree. Facebook is stuck in a range. For me, I think it's kind of a no play. And the reason why I think it's a no play is because A, Facebook is stuck in the range. I can't really make a strong bullish or bearish case for Facebook right now. And B, the The volatility is very low, 11.6. If I pull up the IV chart, you guys have probably seen my Thinkorswim charts. This is which I usually use to look at IV, but in Thinkorswim or Tastyworks, you can view it as well. You can see here the IVR, which is their implied volatility rank, is at the lowest it's been since in a year, right? Pretty low. So I don't want to be selling premium. So since the stock is in a range, oftentimes I'll think about, oh, let's do a credit spread, right? Let's do an iron condor. Here's the chart again. This would be a good iron condor candidate if options premiums were high, but they're so low right now. So for me, I got to be honest, I think Facebook's a no play right now. Not until Facebook breaks this level would I get bearish and start looking at some bearish trades. Or if it breaks above this level here, right at the 290, let's just call it 300 to keep it simple. If it breaks 300, I'll start getting bullish of Facebook. But right now, got to be honest, feels like a no play to me. So guys, thanks for watching this video. I hope this was instructive. I hope you got some ideas in the way I think. And I hope that YOLO conversation with long calls and long puts had some meat on the bone to give you something to think about to take into your own trading. Look, as traders, we got to put ourselves in a position to hit those home runs once in a while, right? I think this YOLO idea that I was telling you earlier might be one of those things, one of those weapons you could throw in your bag to pull out, to go after those big winners that really make a month or make a year. Happy trading, everybody. Happy Sunday night. Have a good trading week this week, and I'll talk to you online. Take care.